Hello everyone, welcome to another episode of Ultra Investor. Today's topic is significant and can enhance your trading strategies, and it is liquidity. By knowing liquidity, you can make better decisions when taking trades, which can result in fewer losses and more opportunities with a greater risk-to-reward ratio. In this video, we'll explain the concept of liquidity from a smart money trading perspective, so you can gain a deeper understanding of how it can impact your trading success. In this video, we'll showcase the market movements that are identified as liquidity grabs and illustrate how you can integrate this concept into your trading chart. Furthermore, we'll unveil our essential liquidity trading strategy that follows particular entry and exit points based on rules. If you're interested in this topic, we suggest clicking on the like and subscribe buttons to show your backing. Thank you for watching. What is liquidity? Liquidity refers to the amount of money present in the market. Each trade involves a transaction between a buyer and a seller. And having more money in the market makes it easier for large investors to trade. For example, if a big corporation like a bank needs to exchange hundreds of millions of dollars into euros, and if they do so during a time when liquidity is low, there will be a sharp increase in price moment. And that they don't want. They want to buy cheap. When it comes to large investors buying large quantities of an asset, avoiding increased prices is a top priority. This is where liquidity comes in, having sellers in the market to meet demand. But where can these liquidity zones be found? Typically, they can be found where retail traders are actively participating in the market. These zones are often associated with demand zones where traders are interested in buying and there is significant buying pressure. Liquidity zones are not limited to retail traders alone, but also include small banks, private institutions, and other investors. As these players place buying orders within a demand zone, it triggers stop losses and sells from other traders, which in turn further enhances the liquidity of the zone. This creates an excellent opportunity for large investors to take advantage of the increased liquidity and make a move towards the upside. By strategically entering the market at the right time, these investors can make the most of the enhanced liquidity and potentially generate significant profits. When the price reaches the trend line, it will receive support. Traders will buy when the price touches the trend line and set their stop losses below it. This area is considered a liquidity zone, while below it lies a significant structural level that has acted as both support and resistance in recent times. Assuming the major level is reached, we will have an excellent chance to trade long, since taking advantage of the liquidity will create favorable conditions for sustaining the price trend, which is precisely what we desire. What are the benefits of identifying liquidity zones on the chart? First, identifying an existing liquidity zone before a demand or supply area can present a great trading opportunity because liquidity serves as the driving force behind the price movements we want to see in the market. Another advantage of recognizing liquidity zones is that it enables you to differentiate between areas with a lower probability of success from those that represent major demand and supply zones. This can help you make better trading decisions and minimize potential losses. It helps you optimize your trading entries and minimize your losses. For example, if the price breaks through a structure level inefficiently, it may leave behind a perfect order block. If the price later returns to fill the gap, this could present an excellent opportunity to place buy orders and capitalize on the market's movements. Following the sharp price movement, the trend became exhausted and created multiple liquidity zones, as evidenced by the subsequent price action. After the support levels were broken, buyers grabbed all the liquidity available and propelled the price upwards. It's important to note that grabbing liquidity before reaching an order block is not a guarantee, as prices can easily break through the block and lead to a significant trend change. Therefore, it's crucial to look for reversal patterns on lower time frames before entering trades. Liquidity zones can take many forms on a chart, including trend lines, consolidation areas, and major moving averages. Recognizing and understanding the various types of liquidity zones can help traders make more informed decisions about their trades. We focus on identifying liquidity zones mainly through equal highs and lows, keeping things simple and easy to apply. Now that we have covered the basics of liquidity, let's delve into our primary liquidity trading strategy. Before we do, we kindly ask that you show your support for our channel by giving this video a thumbs up and subscribing. Doing so will motivate us to create more educational content like this. The liquidity trading method can be used in various markets like forex, crypto, and stocks, and isn't restricted to specific time frames. It's easy to follow and involves just two main steps. First, we determine the trend by using a moving average calculation known as EMA, exponential moving average. This involves applying EMA 50 to the chart and looking for the price to break the EMA in a particular direction. To explain further, this trading strategy involves observing a series of moves in the price chart. Specifically, we wait for 3 moves, with the third move being the one that breaks the structure level. As an illustration, in the current example, the price broke the 50 EMA, exponential moving average, in an upward direction and made 3 moves, ultimately breaking the previous market structure. This indicates that we have identified a bullish trend, as long as the price stays above the higher low. Therefore, we will only be looking for opportunities to buy. Moving on to the second step of this trading strategy, we now look for a pattern known as a liquidity sweep. Essentially, we wait for the price to create a support level and then observe whether it wicks below the support and captures the liquidity or closes below the support and then bounces back up above it. In the current example, you can see how the market created a support level and then captured the liquidity by forming a long wick candlestick that went below the support. At this point, you have 2 options for entering a trade. You can either enter right after the long wick candlestick or wait for confirmation in the form of a candle closing higher than the previous one. It's important to set a stop-loss order below the long wick candlestick to limit your potential losses. As for your profit target, you should aim for the next level of structure. Additionally, to manage your risk and potentially lock in profits, you can consider closing half of your position when the price reaches a 1-to-2 risk-to-reward ratio. This will ensure that you at least break even on the trade, even if the price moves against you after hitting your initial profit target. A critical point to keep in mind is to always look at the higher time frame to gain a better understanding of where prices are heading and how much room there is for them to reach the next level of structure. For instance, before placing a trade, it's a good idea to zoom out to a 1-hour time frame to get a bigger picture of the market. In the current example, we can observe that the price has recently broken the structure to the downside and has a considerable amount of space to go until it reaches the next level of structure. This information can be crucial in determining the potential profitability of a trade and managing risk accordingly. If the price breaks the higher high to the upside, we will shift our focus to buying opportunities on the lower time frame until it reaches the next level of market structure. Now, let's take a look at a bearish example. In the current chart of the Euro-USD pair on a 15-minute time frame, we can observe that the market has broken the EMA 50 to the downside, with 1, 2, and 3 moves. This indicates that we have a bearish bias in the market. Following the EMA 50 break, the market formed a resistance level and broke above it, only to immediately retreat back into the range, creating what is known as a failed breakout. This is precisely when we would execute our trade. It's important to remember that this strategy is not limited to any particular time frame or session. However, it's always recommended to conduct your own backtesting to determine which parameters work best for your trading style. So, I hope this video has been helpful to you, and good luck with your trades. If you found this video useful, please show your support by clicking the like and subscribe buttons. Your support will help us continue producing more helpful content like this. Additionally, feel free to share your thoughts and questions in the comment section below. We always do our best to respond to all comments. Thank you for watching, and we'll see you in the next episode.